Good morning, folks. Disclaimer. The views you hear here may not necessarily reflect the views of J.P. Morgan Chase. And just to make sure I'm covered, the views may not even reflect the views of the person speaking. Age of personal responsibility. 5 years ago, we had about 153 million people had jobs. That was about 62.7% of the population. By the time we hit bottom 2 years later, we had lost about 15 million jobs. Since that time, businesses have recreated or replaced almost 5 million jobs. But what that means is there's about 143 million people with jobs right now compared to that 153 million back 5 years ago. And when you break that down, what that means is there was about 5 million people, more than the normal number of unemployed people, who are actively looking for jobs, can't find a job, and have yet to find a job. Then there are about 4 million people, you may own some of them, who got out of school, couldn't find a job, have disappeared somewhere. They're not actively looking, so they're not called unemployed. And of course, because more and more people are retiring, there's about 1 million people who have retired and dropped out. So in my book, when I think about where we are in the rhythm of life, in my book, we have recovered or replaced about 35% of the jobs that we need in order to get back to where we were. So think of it this way, in terms of the recovery that we're in, we're probably in the top of the fourth inning. So we've got a lot of work to do. Now, stock market, reality check. The top line on this picture is showing you the Wilshire 5000 Equity Market Index. That's the broadest measure of publicly traded companies. And everything in the picture is shown in relation to where we were at the last peak, October 9, 2007. And what the picture shows you, the blue line, by the way, is the stock market excluding the US. What the picture shows you is the market is almost back to where we were. So, and by the way, footnote, we all know about the fiscal cliff at the end of the year. So despite this, this is where the equity market is. And the question is the following. Is the equity market doing what it's doing? Is this strictly because of the Fed? Or are there things happening that make us believe that a recovery is underway and there's more to go in the days ahead? And that's what I want to talk about. I think you can make a pretty good case that we've got the makings of a decent recovery. It's underway, it's very slow, and there's a lot of work to do. But I think it's not hard to figure out why it is that the equity market is doing what it's doing. It always is ahead of the game. The market is always going to be anticipating where we're trying to go. So, to me, watching the economy is an awful lot like watching the motion of the ocean in the following sense. You know when you're at the beach and you're watching the waves roll in and out, you know that by watching the waves, it doesn't really tell you much about what's going on with the tide coming in or the tide going out. Because waves roll in and out all the time, whether the tide's coming in or out. And to me, the economic data that we get and the mood swings that we get are very much like watching the waves. So I think when you're in a period of time when something really bad has happened, we're in transition, I always think you get more by trying to understand where is the alignment of the moon and the sun. And that's what I want to think about this in the next few minutes when we're talking about the overall economy. Now here's a picture that shows you the broad trends around the world. Just a couple sound bites on each of the key themes that are going on. The picture shows you growth trends over 4-quarter periods. This solid shaded area is the growth of the whole economy, the whole global economy. And what it shows you is we had a very bad recession in 2008. We recovered, we're starting to recover. We faded out a little bit this year. And the question is why and where are we going? The top two lines show you growth in China and India. The next line shows you growth for all the other developing economies. Japan, Europe, and the US are the bottom lines. The line that drops sharply and bounces back is Japan. The key thing here is that if you could focus on the European Union, the European Union has stalled, and that's really the main driver of a lot of the slowdown that's taking place in the global economy this year. The European Union was growing about 2.5%. It has stalled essentially in the fall. We know why. The financial crisis is causing big problems, and it's made people worry about the sustainability, the credibility of the monetary union. I think we're getting a pretty clear sign now from most of the architects of the European Union. I think the way you're supposed to think about Europe and the project they're on is you have to respect the scars of history, for one, which are in the background driving this desire to come together as a family. Secondly, the economic benefits of working together as a family is what's really driving this. And I think what we're learning from the European community is they are being forced to re-examine their commitment to this path that they set out on several decades ago. And the signals, to me, are pretty clear that there is a strong commitment. We understand why, because the benefits of economic integration are overwhelming. But the things they need to do to finish the project they began a while ago require political solutions, and everybody has to feel like it's fair, and everybody has to feel like they have shared goals, and that's the challenge for Europe. So I think what we are learning and what the market has realized is that this project will continue. It's too important for the Europeans for it to continue, and it's unthinkable to think about what might happen if the whole union breaks up. So, you know, an underlying theme in my view about how to think about what's going on around the world is good times make us lazy. Bad times make us focus on what we need to do to get things moving. And I think this is what's happening in Europe. Now, when you go to the developing world is very dependent on exports to all of us, the developed world. So to me, what is happening in Europe, though, which is slowing down the growth of the developing region, it's not ending the project what's going on in the developing world. It's slowing them down. But to me, Europe's stall is doing for the developing world what their central banks were not doing. They were growing too quickly. It was causing all kinds of inflation bottlenecks. They weren't tightening enough to get a grip. And what's happened here is that the European slowdown is helping to slow the developing world down to a more sustainable pace. And to me, this is a very healthy outlook. So when I think about what lies ahead, we expect the European region will slowly begin to pick up speed again as the crisis gets behind them and they get to work on finishing the project that they began. And the developing world, there are things happening there that are helping to bring them down to a more sustainable pace. So in my mind, as I think about our own forecast, what we're expecting, the picture that I see in the coming years of a slower global economy, but a more sustainable one, to me is a healthy outlook and healthy for all of us. Now, one quick footnote on what is going on in the developing world. We all like to know, so where are we in the process? I think the easiest way to understand what's taking place in China and India in particular is to think about where are they in terms of living standards. And what this picture is showing you is the evolution of the living standard in the US in today's terms since the 1800s. Today, the living standard in the US is about $35,000 to $40,000 per person. And what the picture is reminding us is that for all that has happened in China and India, they are still essentially about where we were in the late 1930s. So what that tells you is there is a lot of work to do. We're probably in the early innings of this story that's developing in Asia and Latin America and Eastern Europe. And what that means is there are tremendous opportunities for us, tremendous challenges, and tremendous benefits, I think you'll see in a couple of visuals. Now, to the US. I think an interesting perspective to keep in mind is when we look at US growth, we're all very frustrated. The economy is growing very slowly. relative to what we expect when you drop into a big hole and then try to get out. What this picture is showing you is the dark line is actual GDP growth. It tells you that we've been growing about 2% for the last year or so. That's what the initial numbers say anyway. It's kind of hard for us economists, by the way, to reconcile that 2% growth with a job market where employment is growing about 1.5%. And it's a reminder to all of us that when you're trying to follow a complicated economy like this, we don't always, the first answer is not always the right answer. Unlike when you take an SAT test. Often the right answer is the last answer. And we are going through lots of revisions here with the economic data, and we should know in our minds that we won't know the final answer to what really happened for another couple of years. We saw this play out when the economy was going down. They told us belatedly that in fact the economy dropped more sharply than we thought. Well, if you had been looking at the employment picture, you would have known that. But what's interesting to me about this picture, what it tells you is the overall economy growing about 2%. Now, if you take out the public sector, take out government spending, state and local government spending, what it tells you is that we've been growing faster than 2%. The private economy growing almost 3.5% on balance. And you know what's interesting to me about that is true even though our building business still is very dormant. It's only beginning to wake up. Because of all the excesses in the last decade, you can't get those behind you until you underbuild and you clean up some of those excesses. And that's what's been plaguing our economy in large measure. Now, the other thing that's an issue here, and it's demonstrated in this picture, is that when the economy went into recession, we did some major fiscal stimulus. And that stimulus cushioned the overall economy some, but as you'll see from the line that goes way down, the private sector really dropped sharply. What's been going on in the last couple of years is that by design, when they did that fiscal stimulus, it was intended to start winding down in 2011 going forward. So part of what we are feeling right now in the US is the unwinding of fiscal stimulus, which soon will start to stabilize. So to me, there are two implicit messages from this picture. It's telling us that even if nothing else is done, in time, as the unwind of fiscal stimulus settles down, as the home building business gets back on its feet, which it is doing now, we should expect to see faster growth in the U.S. Now, let me just highlight for you a couple themes that I think are at play here, things that are helping to drive the shift in economic activity. One of them you have to respect, you can't ignore it. Not everybody's happy about this, is the action that the Federal Reserve is taking. The Federal Reserve has cut short-term interest rates to zero. Because they can't go below zero, they have been buying assets, the purpose of which is to drive other interest rates lower. And this is what you see. This picture, this visual is telling you how potent those asset purchases are. What I'm showing you is the 10-year Treasury yield and breaking it down into its inflation component and the real yield. And the thing that is most telling, when you look at that blue area, that's the 10-year TIPS yield. That is the rate of return you're getting on a Treasury after you make adjustments for inflation. It's in negative territory. This all has unfolded ever since the Fed began to buy assets. And clearly, in other words, when people say the Federal Reserve's asset purchases are having no impact, this picture belies that. What it's telling you is that the Fed's actions are really driving all risk-free rates down, and it is creating incentives for people to move funds out of risk-free assets into riskier assets, and the credit is starting to flow to riskier parts of the economy. It's an important reason, by the way, why the auto industry is seeing a pickup in car sales. Car sales are back to almost 15 million. Subprime car lending is growing much faster than regular lending, and the reason is investors are migrating to riskier assets, and that's all part of what the Fed is doing. Now, some people, there are plenty of reasons to criticize what the Fed is doing, but I think one fear that people have doesn't really square in my mind. There is a perception that what the Fed is doing by buying assets and creating reserves, it's monetizing debt, and that is creating a potential inflation problem. But what the Fed is doing is really very different from anything we all learned. What this picture is reminding us is that when the Fed buys the assets, creates the reserves, it's boosted the monetary base, which if you stop there, most of us would say, well, that's the issue. When you increase the monetary base, it has the potential to become money. But the problem is, as the bottom line shows you, the Fed's actions, the creation of reserves, are not morphing into money. What we don't tell students often in school, in your money banking classes, is the process of creating money when the Fed creates reserves is a partnership with the banking community. The banks have to take those reserves, lend them out. But the increase in the reserves that the Fed has been doing when it buys assets are piling up as excess reserves, which means they don't go anywhere. They're not being used for anything. So the potential to be an inflationary threat, I think, is somewhat exaggerated. And what we all are anticipating or assume is that as the economy starts doing better and the Fed backs off, they will unwind a lot of this monetary base, and you'll never see the potential threat that it has to inflation. But this is a concern for a lot of people, and worth being aware of. Now, second issue, and something that I would have never really focused on in the past, what's going on around us is becoming very important. We're helping, we're enabling this process, and I think you sort of get an idea of how important the global backdrop is when you look at what's going on with our export flows. The picture here the picture on the left shows you the percentage of U.S. exports that went to the developing world and to the developed world. And what it tells you is, and then it shows you on the bar on the right is showing you what's going on now. And what it tells you is the majority of our exports now are moving into the developing region. So these new markets that are rising and being created are creating new opportunities for our business community. It's a sign of the times, and I think it's a sign of what we face in the future. I think when we economists are asked to think out where's the growth going to come from in the future if these processes continue, what we tend to conclude is that 60% of the world's growth is going to be coming from the Asian region, from the Latin American region. And just to put a face on how big this is, when I look at our own forecasts for the Asian region, I look at where GDP growth, what GDP is today versus what we think we will see 12 months from now. The increase in the GDP for the Asian region is about equivalent to the entire size of the German economy or the entire size of California, Oregon, Washington. So every year, this process is creating huge new markets, huge new opportunities. And this is showing up that we're all aware of this, and this is an important driver for everybody. Now, another issue, one of the big drags in the U.S., one of the things that has been holding us back is the cleanup that's been going on in the home building business. And we've never seen a recovery that did not have a recovery in the housing industry. What the picture here is showing you is the contribution of the housing industry, home building activity, to GDP growth. And what it shows you is, finally, we're beginning to see the light. The home building business is beginning to see the light. Why is that? Well, there's a whole bunch of reasons, but one important reason is, if you look at what builders are doing, we built way too many houses in the last decade as a result of the excesses and easy credit. And so in order to clean that up, the builders had to underbuild for a while. And that's what the shaded area here is showing you, the level of housing starts. The normal level of housing starts is somewhere in the 1 million to 1.5 million. In order to accommodate everybody who needs a place to live, we have to build about 1 million to 1.5 million houses. For the last several years, we've been underbuilding. But because we've been underbuilding, the builders have pretty much cleaned up the glut that was created in the last decade, and that's why you're beginning to see some signs of life. Home building activities beginning to pick up, and in the real estate area, house prices are back to normal levels. So there are things going on the supply side and the demand side that are helping to address the excesses of the last decade. This picture kind of gives you an idea of what went wrong and how to think about what's normal and what's not normal. The shaded area is income per household. Everything starts at 1 in 1970 on the left side of the picture, and I'm showing you the evolution of household income. At any point in time, you're looking at the ratio of where you are now to where you were in 1970, and the black line is house prices. And the reason for doing this is to use income as a proxy for what can we afford, and therefore, what would you think is normal for house prices. And what the picture shows you is the debacle. House prices rose far more than anything we'd ever seen before. And so, not surprising, when the music stopped, the prices came down. It's created a lot of damage. The prices are back down to where they normally are. And this, by the way, is the reason why you're starting to see house prices rising. Now, of course, there's a whole generation of home buyers who have seen their parents' house go down. So what's really holding people back right now, frankly, is not financing conditions. Financing conditions are phenomenal. 3.5% mortgage rates? You've got to be kidding. When at 3.5% mortgage rates, most people can qualify for a mortgage that's about 5 times their income, in contrast to the old days when interest rates were much higher. You could not qualify for anything like that. So what's really holding the real estate industry back is the memory of this big collapse in house prices. And I think as people start to see that much of this is behind us and we're moving forward, you would expect to see attitudes about owning a home versus renting a home begin to shift. Now, a couple more things to focus on the U.S. economy. And I think for an economist, this is the most stunning picture and the most important picture that tells you it's time to look forward. We've always, business cycles, economic cycles are largely about volatility in the business community, because we in the business community have shareholders, we live by mark-to-market rules, we are run by family businesses, we don't have the luxury of making mistakes, we invest in projects that produce revenue far into the future. So when things make you nervous, something about the future makes you nervous, and you turn cautious, you start to shelve projects, you pull back, you downsize your staff levels. So we economists have always known that when you're trying to figure out, is the tide going out or the tide coming in, you want to be aware of what's going on, the health of the business community. And you'll notice this picture is showing you after-tax profits as a percent of GDP. And you'll notice that often in the past, when margins are getting squeezed, because people are too optimistic, margins are getting squeezed, it's a warning sign that something bad is about to happen, that people are going to cut back. And you'll notice that every time we go into recession, before you get there, margins have been getting squeezed. Now, if you look at what's going on right now here, there's 2 big messages. One is that the business community has done an amazing job restoring its own financial health. So out of that crisis in 2008, people went in survival mode, and they managed to restore their profitability. We're now in record territory. And the other thing to be aware of is you look at this picture and you get the feeling there's a pendulum shift. And I think this is a story about globalization. Countries, sleeping giants, wake up, want to go to work. They want help. They open their borders. They invite folks to come there, build operations, bring the products back here. Anybody who's on the front lines of that story is going to be benefiting from this. And that, I think, is what you're looking at in this picture. This is a story of globalization. One more thing going on. When you look at the manufacturing sector, after the chaos of the 2000s, people had the feeling that, well, we in America don't make anything anymore, manufacturing has gone abroad, and all these jobs are outsourced. The truth is, the lights are coming back on in manufacturing, although it's a new, more dynamic, more efficient, higher tech manufacturing sector. And I think one thing to remember, obviously when you go through bad times, you reinvent yourself, and that's a lot of what's been going on in the manufacturing industry. It's why the Great Lakes region and the southeastern part of the country are actually on the leading edge now of the recovery. They are driving a lot of what's going on. We've created about 500,000 jobs in manufacturing, but it's important to remember also there's a lot of things going on, but an important thing is that the value of the dollar in real trade-weighted terms tells you it's very attractive to locate operations in the U.S., and this is why we're seeing more and more Europeans, Turkish companies, Japanese, wanting to locate here, an awful lot down in the Rio Grande Valley area where the manufacturing belt is. One more thing, when you look at the energy sector, in my mind, there's a quiet revolution going on. You folks here know more about this. As a result of that technological advances in developing gas shell pockets, there's a huge development, a huge discovery of new supply of energy. To me, as an economist, the way to think about this and what it's doing is to look at the relative price of each. Price of oil on the top line here, about $95 a barrel. If you convert natural gas prices on a thermally equivalent basis to dollars per barrel, it's about $15 a barrel. What that tells me as an economist is that as a result of these discoveries, we've found a vast new supply. The prices tell you there's a tremendous incentive to figure out what to do with this. So in the petrochemical industry, we are rebuilding operations here. In the power generation business, natural gas is making inroads. In the transportation business, trucking companies are moving short-haul fleets to natural gas. To me, this smells like economic energy. You see it here in terms of the development of energy sources, but in terms of the broad economy, a discovery like this generates a lot of activity as we rethink the way we do energy. So in conclusion, going back to the beach, you know, if you like to build sandcastles like I did with my kids when we were at the beach, what you know is if you're at low tide and you're spending a lot of energy building a sandcastle right there where the current reality is, you know that you're going to be washed out when the tide comes back in. If you're pretty sure it's low tide and the tide is coming back in, you try to figure out where is the high tide mark. That's where you want to build the sandcastle because all that work will not be destroyed. So I really think this is the way the investor community thinks, this is the way the business community thinks. When we're pretty sure the tide is coming in, and I think the signs are pretty clear now, and you're pretty sure you know where we're trying to head, it makes you think more about where is it that we're trying to go, where is fair value for assets, and if you're in the business community, you've got to ask yourself, where do you want your where do you want your business operations to be when we finally get to where it is that's guiding the Fed. So I think this is why it's time to think, to realize the tide is coming in. It's time to plan, and I think this is what the business community is doing because it takes time to get projects in place because you know your competition's going to be doing this. So I think that's where we are today. We've got a lot of work to do, but I think we're all pretty sure the tide is coming in, and it's going to be some time before we get to high tide. Thank you very much.